Before today's markets close, you'll learn how soaring mortgage rates could impact your investment strategy.
Absolutely. Insights from industry leaders like George from Rebel Capitalist and Mike McGlone from Kitco News are crucial.
The key takeaway? Rate cuts from the Federal Reserve aren't driving down mortgage rates as expected, leaving potential buyers in a quandary.
And that's just the tip of the iceberg. You'll also discover how the robust US dollar could pose challenges to the global economy.
Stay with us. Up next, Lance Roberts will explain whether we're poised for a massive stock market correction. Don't miss it.
And later, Mike McGlone will share insights on gold potentially reaching new heights amidst current market conditions.
Just a quick reminder, this content is for educational purposes only and not investment advice.
So let's jump into the essential insights you can't afford to miss.
Next up, we dive into the implications of skyrocketing mortgage rates with insights from George.
George reveals how the Fed's rate cuts are actually leading to an increase in mortgage rates.
George highlights that while the Fed is cutting rates, mortgage rates are surprisingly climbing, which is counterintuitive.
It's a puzzling situation. He illustrates that the relationship between the Fed's actions and the resulting mortgage rates isn't as straightforward as one might expect.
Exactly, and he points out that long-term rates often have a greater impact on the housing market.
George elaborates on how the Fed's goal was to bolster the labor market.
But why are mortgage rates reacting inversely to the anticipated drop due to those cuts?
That's the crux of his analysis. The reality is that even with the rate cuts, market conditions are not aligning as anticipated.
George forecasts that if the Fed doesn't adjust its course, the housing market could cool down significantly by 2025.
It's a delicate balancing act, one that many homeowners will be watching closely.
George leaves us with a critical takeaway. The relationship between Fed actions and mortgage rates isn't always what it seems.
It's essential for potential buyers to stay informed to make the best financial decisions moving forward.
Today, we're summarizing a thought-provoking analysis from Eurodollar University's recent video, where a key expert breaks down how the US dollar is unexpectedly thriving despite predictions of a downturn.
It's fascinating how this shift challenges the mainstream narrative surrounding central banks and inflation.
The expert highlights a surprising fact. Despite the Fed cutting rates, the dollar not only remains strong, but actually gains value. Why is that?
Exactly. It suggests there are deeper issues at play beyond just US monetary policy, like instability in emerging markets and global economic imbalances. The analyst points out that central banks, which initially stood firmly against rate cuts, ended up cutting rates frequently as the economic situation worsened.
So they're essentially backtracking on their original plans? That sounds like a massive policy flip. The expert predicts that the dollar's ongoing strength might spell disaster for emerging markets.
This situation places enormous pressure on these economies, limiting their recovery options.
In wrapping up, the expert emphasizes that lessons from 2024 will shape how economic strategists approach 2025.
Absolutely. It's clear understanding the dollar's rise is crucial for anticipating global economic trends.
Today, we're delving into the Santa Claus rally discussion with Matt from Trade Brigade.
Matt suggests that despite recent market moves, there are still reasons to be hopeful about the upcoming rally.
Matt asserts that the S&P 500 must hold above 585, or we risk falling into a bull trap.
That's interesting. What's the historical context behind this time of year?
Matt notes that previous Santa rallies closing green have shown over 90% probability of a positive year-end. Matt interprets the inverted hammer signs as indicating neutral market sentiment currently.
Notably, a healthier bullish setup would entail significant progress toward the upper range.
If we slip below these key levels, it's a clear signal to reassess our bullish stance.
That definitely adds tension to the outlook. Matt's perspective here is vital for traders.
Matt emphasizes that the best-case scenario relies heavily on price action remaining above that pivotal level.
However, he warns that slipping below could signal a shift to a bearish trend.
Ultimately, Matt drives home the message: vigilance and adaptability are key.
Definitely. Being proactive about market shifts is essential for traders.
Today, we're analyzing whether this is indeed the peak of the stock market, guided by insights from Lance Roberts, our resident financial expert.
There's an unprecedented level of consumer confidence and record equity allocations, which historically indicate market peaks. Let's dive into that.
Lance points out that both household and professional investor allocations to equities are at unprecedented levels.
Exactly, and when we see this level of exuberance, historically it has often marked the peak of market cycles, not the beginning.
It's like when everyone's confident about the party. Usually, it's right before the music stops.
Historically, each time we've seen these indicators align, it's been right before a market peak.
That creates a sense of urgency. Should investors be cautious now?
Absolutely. It's a sign to keep your eyes peeled for potential downturns. As we look to 2025, there's a concern that the bullish sentiment may not continue.
Exactly. Those high expectations could lead to real disappointment if reality doesn't align with them.
Are firms underestimating potential corrections?
Yes, with valuations at extremes, a correction could hit hard.
Investors need to evaluate if those high earnings predictions are realistic, considering current market conditions.
What are solid indicators for future earnings?
We really need to analyze economic activity. If it dips while expectations remain high, we're in trouble. Lance predicts that if these market dynamics play out, we might see some rough waters ahead.
And in the worst-case scenario, a substantial market correction that catches many off guard.
Lance emphasizes staying focused on market trends and exercising caution.
Right, knowledge is power, especially in an uncertain economic landscape.
Today, we're diving into gold's potential surge to $4,000 by 2025 with Mike McGlone from Bloomberg Intelligence.
Mike, with gold hitting record highs, let's explore whether it can really sustain such a rise.
McGlone believes gold could truly break through the $3,000 barrier, but only if the stock market sees corrections.
Absolutely, and he points out that the current market cap to GDP ratio for the U.S. is at a staggering 2.2, reminiscent of the pre-1929 crash times.
Mike highlights that, with the stock market currently so inflated, a simple reversion could spur an upward trend for gold.
Right, and if he's correct, the implications for investors could be substantial. It's a classic case of what goes up must come down. McGlone mentions that Bitcoin is attracting younger investors, which poses a challenge for gold's traditional market.
So, does that mean gold needs to adapt or risk becoming obsolete in investment portfolios?
McGlone segments geopolitical tension as a significant underpinning for gold's increasing relevancy.
So these tensions create not just concerns, but also opportunities for gold to shine as a protective asset. McGlone predicts that only a withdrawal from high stock performance can we see gold reach new heights.
Which leaves investors in a bit of a paradox. Do they invest in gold now while the market looks uncertain? In summary, McGlone's insights push for a balanced approach to investments with a healthy eye on gold.
Indeed, as global uncertainties linger, gold might prove to be a pivotal asset in safeguarding wealth.
Today, we're diving into the complex and escalating tensions in the Middle East with Trita Parsi, an expert on the topic.
Parsi highlights the recent Israeli strikes in Yemen and discusses the broader implications for the region.
Parsi emphasizes that targeting civilian infrastructure reflects a strategic choice by Israel amidst the chaos.
He questions why Israel isn't more focused on military targets, noting the lack of effective intelligence on Houthi leaders.
And it's noteworthy that this escalation happens alongside US policies, which, as Parsi notes, lack pressure on Israel to restrain its military actions.
Parsi discusses the alarming trend of Israeli strikes on what he calls civilian targets under the guise of battling the Houthis.
Is that why reports show such high civilian casualties? It seems to reflect a broader pattern of military engagement.
Indeed, it raises serious questions about the moral implications of these strategies. Parsi notably expresses concern that escalating tensions could lead to outright war before the presidential inauguration.
He posits that the next few months are critical and that diplomacy must play a role to avert disaster.
As Parsi illustrates, the path forward requires not just military solutions, but thoughtful diplomacy.
And the message is clear. Without accountability, the cycle of violence will likely continue.
Wow, we really covered a lot today. Each guest had something unique to say.
Absolutely. Trita Parsi's insights on potential conflicts really illustrate how fragile the situation is.
And Mike McGlone predicting gold hitting $3,000. That's a bold forecast.
Yes, and it stems from the current economic shifts and the looming geopolitical uncertainties.
Then we have Lance Roberts sounding the alarm on market exuberance.
Exactly. He points out that despite high consumer confidence, it's wise to stay cautious.
Matt's perspective on market trends adds to that, showing us how crucial timing can be.
And let's not forget the anonymous expert who brought up the US dollar's strength. A real eye-opener.
Right? Those insights challenge our understanding of central bank implications.
In the end, isn't it fascinating how they all agree on monitoring indicators but diverge on strategies?
Definitely. If you all found these insights valuable, hit that like button and subscribe.
Your support helps us to continue bringing you the best analyses from top financial minds.
And don't miss our next video, where we'll dive into the impact of global trade dynamics. You won't want to miss it.